Good morning. It's not raining. It seems like the last few times we had these during the spring, it was raining, and now we have a beautiful day. So thank you so much for attending Aspire. We have a great program today for you. It's on the update for oil and gas. So I know everybody's going to be interested in hearing that. It affects our economy so dramatically. So after we hear all of our good information today, we'll know exactly how to invest our stocks. So we are in our 26th year at Chapman Hext, and so we're excited to be being successful, and that all is because of you guys. So we thank you, and thanks for attending Aspire this morning. So in front of you are the programs for today. And you have your evaluations for CPE, if you'll fill that in and turn it in at the desk when you leave. And then you also have the evaluations for Aspire. So fill those in. And so today our speakers are Reed Thompson and Haley Edwards. And so I will turn the program over to them and let them give you all the good information.
Thank you.
Thank you.
Well, let me say good morning again and welcome. Thank you all for coming out. I want to introduce, I'm Reed Thompson with EastWest Bank. This is Haley Edwards. I'll let her give her a little introduction.
I'm Haley Edwards. I joined the bank actually in May, so it's only been a few months, but that's after 10 years with a couple of previous institutions, all here in Dallas in oil and gas lending. So we are a newer bank to the oil and gas market. So we entered the Texas market a couple of years ago and really ramping up since September of last year into the oil and gas market. So exciting opportunities for us right now. I'll let Reed continue.
Again, Reed Thompson, I'm Senior Relationship Manager for EastWest Bank. I joined the bank in January. We started making oil and gas loans last September, as Haley said. I left Wells Fargo Bank after 15 years. I've actually been in oil and gas lending for about 35 years. So I've seen a few up and down cycles. I've seen $10 oil twice. I've seen 90-cent natural gas. So I have a lot of experience in oil and gas lending with a lot of different institutions. So we'll get into it a little bit later in the discussion. But the regulators changed our world earlier this year. So a lot of things that we've done for the past 30 years are no longer applicable. The fundamentals are still the same, but it's kind of changed our business model a little bit. And I want to thank our sponsor, Chapman Hext, for inviting us out. I don't know how they found us.
Right.
We're in the adjacent suite on the 8th floor, over in the West Tower. So that's how they became familiar with EastWest. It's not on the agenda, but I wanted to give you a little intro to EastWest Bank. I think the biggest misconception is that we're somehow owned by the Chinese. It is true that 45 years ago, the bank started as a federal savings bank to cater to Chinese American businesses in Southern California. We are headquartered in Pasadena, California, but we're the 23rd largest publicly traded bank in the country. And so nobody owns more than 1.5% of our stock. And we're about $34 billion in assets. So it's not a small institution. It's what you might call a mid-sized regional bank. We came to Texas 2 years ago when we made an acquisition of Metro Banks down in Houston. They did have 3 branches in the Dallas market. So beginning with that, the management in Pasadena said, well, we're in Texas, we might as well be in the oil and gas lending business. So fortunately, we missed $140 oil and we came into the market at $40 oil. So needless to say, we don't have any problem loans. I don't have the regulators on my back. We don't have a workout group. So we're taking advantage of assets changing hands and financing new transactions. That's principally our business model today. So jumping into the basics, crude oil. As you always see crude oil quoted in terms of dollars per barrel. Well, obviously as consumers, we don't buy a barrel of crude oil. The first purchaser for the crude oil is the refining business. And this is an illustration very simple illustration of what we call an atmospheric crude unit, which is the starting point in the refining process. So as you can see, all the crude oil goes into the tower at about 1,200 degrees Fahrenheit, and as it cools, the molecules rise up in the tower and they're drained off at particular levels to generate these different products. Now for crude oil, as you can see, the middle slate of this product set is transportation fuel. So the highest and best use for crude oil is in the transportation fuel sector. At the lower end of the molecule chain, you have road tar and asphalt, and at the upper end, you've got the natural gas and liquefied petroleum gas products that come out of the top of the tower. It's important to note that there hasn't been a new refinery built in the United States in the last 40 years. I mean, who wants one of those stinky, nasty things in your backyard? So what we're dealing with is older technology, older configurations, and that is important for later on in our conversation when we talk a little bit more about crude oil. Now, natural gas is almost wholly a domestic product. It's produced in certain regions of the country and consumed in generally different regions of the country. Now, it's a mature business, so the infrastructure from getting gas from the producing region to the consuming region is fairly well built out. It's fairly efficient. So as you can see from this pie chart, about 35% of natural gas is used for electric power generation. And that's probably natural gas's highest and best use. That's followed by industrial manufacturing and residential consumption. Rounding out the pie chart is commercial activities, which is commercial buildings. And the rest of it, about 10% of the gas is actually consumed in the process of producing it and transporting it to the market. Then on the larger power segment, you can see the different sources of power being petroleum, natural gas, coal, renewable energy, which you see a lot in the headlines, and nuclear power. Now, right now, natural gas is about 28% of the market. You can see that increasing because gas is plentiful. The price is low because the supply-demand is a little bit out of balance. Coal, on the other hand, as you see from the headlines, is becoming disfavored, and you'll see the coal percentage of the power sources shrink and be supplanted by natural gas. Renewables at 10%. Renewables have their limitations, and I personally don't see the renewable energy sector getting much larger than the mid-teens in terms of its contribution to the overall power source. Nuclear ought to be fairly static at 8 to 10% because there's not going to be a whole lot of new plants being commissioned in the nuclear space. As you can see how the percentages line out, natural gas, its highest and best use is for power generation and heating residences and businesses. Petroleum, on the other hand, its highest and best use is as a transportation fuel, as you can see with the 71% contribution. Now, I know we have a question and answer page for the back end of this presentation, but if you have a question, just feel free to ask it. Now, the factors impacting natural gas prices, again, it's principally a domestic product produced in one region and consumed in another. There's adequate pipeline infrastructure to get gas from one place to the other. Very little gas is imported. We'll talk a little bit later about LNG, liquefied natural gas, and the infrastructure was originally built out to receive LNG shipments into the country before the shale revolution created a surplus domestic supply of natural gas. And now that's being retooled and turned around to where we're actually going to be exporting, be a net exporter of liquefied natural gas. Now, gas is a seasonal product, and it's also, its price is dependent upon economic growth and the price of competing fuels. There's not a lot of fuel switching capabilities, some from crude oil to natural gas, not a lot from coal to natural gas. So the fuel switching is not going to be a big factor on natural gas prices going forward. As I mentioned, or maybe I didn't, crude oil is a global commodity. It's traded in US dollars. That was determined back in the early 1970s when the US dollar was considered to be the reserve currency of the world. Everybody wanted to be in US dollars. So that still is prevalent today. Almost all crude oil is traded in US dollars, which, to the second bullet, a stronger or weaker dollar is going to affect, on the margin, the price of a barrel of crude. A stronger dollar buys more barrels, so the price per barrel goes down. In fact, so every time you see the dollar strengthen against the sterling or the euro or the yen, you should see a corresponding downward impact on crude oil prices. Now, on the supply-demand, big in the headlines, big news the last couple of years. Again, our domestic activities and the shale revolution, as I refer to it, created a supply on the domestic side, which has created, it'll be on the slide later, the United States is now the largest producer of petroleum and petroleum-related products in the world. We finally surpassed Saudi Arabia and Russia for that distinction. And so with that, and then a global slowdown in economic activity has created, as you read in the headlines, a surplus of supply in crude oil. So right now we have a depressed oil price that probably is going to be range bound between $40 and $50 a barrel for the next 6 months to a year until the market is fairly stable right now. There's some balancing between supply and demand. I think that needs to persist for a period of time, again 6 months to a year, before we'll see prices much above $50 a barrel. That's my personal outlook. That's not the official position of EastWest Bank. And of course, the rig count is big in the headlines. It is directly correlated with what the value of the product is. So we've seen some gains in rig count directly related to crude oil being above $45 a barrel towards $50 a barrel. Some of it is just people have to work their rigs. They have leases that they have that if they're not drilled, they will have to surrender them at some point in the future. So whether it's economic or not, or on the margin, some operators are having to put rigs to work just to preserve assets. And I've mentioned the shale revolution a couple of times. These are the major shale basins in the lower 48 states. I think it all started out with just north of Fort Worth. The Barnett Shale was the first big shale play in the country. It was a gas shale play. The technology that was applied there in terms of horizontal drilling and hydraulic fracturing were new to the business. I mean, we had both horizontal drilling and hydraulic fracturing for decades. This was the first time that the two were combined to break down the shale rock to produce reserves that we've known were there for a long period of time. They were just not commercially viable to produce at the price at the time, given the technology. That extended over into Louisiana, into the Haynesville Shale, which further extended into the Pennsylvania, Marcellus, and Utica shales. And then they decided, okay, let's try to apply this technology that we've learned in these gas shales to oil. So up in North Dakota, up in the Bakken, that was the first oil shale, big oil shale development. Heard a lot of news about the Bakken. It's remote. The only way to get oil from the Bakken down to the Gulf Coast where the refining capacity is by truck or by rail. So again, we've seen many headlines about putting crude oil on rail. So, and it's important to note that we've known these shales were here for, like I said, decades. The problem is that we refer to this as source rock. It's where the hydrocarbons originated and so they're naturally more depleted than the conventional reservoirs that have basically all been found. You know, the reason we're producing shale rock today is because all the easy oil has already been found and is basically on production. As I alluded to, the shale revolution, particularly in oil, has created the United States as being the top petroleum producer in the world, followed by OPEC, with Russia, the one standout. We're going to talk a little bit about, Haley will touch on OPEC and its impact to the markets, but this is a fairly new phenomenon. And so, and this is a question that begs asking, okay, if we're the largest producer of petroleum in the world, why are we still importing 7 million barrels of oil a day? Well, the problem is, as I alluded to earlier, is that the refining capacity in the United States is at least 40 years old, sometimes 60 years old. And when the refineries were configured, they were configured to process a particular type of crude. Not all crude is created equal. You have sour crude that comes out of Venezuela and Mexico. You have light sweet crude that is produced up in the Bakken and in West Texas. So since we were a net importer of over 50% of our crude needs for a long period of time, the refining capacity was geared towards producing that particular kind of barrel. Now, with the advent of the light sweet crude coming in, there is only a certain amount of blending you can do with the light crude quality and the heavy crude quality in order to continue to run the refining business at a maximum capacity. And because of that, we still need to import heavier crudes to blend with our light crude feedstock in order to keep the refining business moving. And the problem with that is to retool a refinery or to build a new refinery, you'd have to comply with all the new EPA and government regulations, which simply makes it uneconomic to go in that direction of retooling our refining capacity. And again, oil being a geopolitical animal as it relates to price, you can see back in the 50s and 60s, the price of crude oil was basically determined by what we call the Seven Sisters, or the original companies that form the major oil companies today. So they set the price. That was until 1973, when the United States backed the Israelis in the Yom Kippur War, and the Arabs created the Arab oil embargo. Now, what happened with that is the United States says, okay, we're overly dependent upon foreign crude, so we're going to develop the Strategic Petroleum Reserve. And so a lot of oil went into filling up the Strategic Petroleum Reserve as the price rose. And as you can see on the timeline, the different international geopolitical events and some of the financial events that happened here lately have caused the price to fluctuate wildly. And in a lot of these cases where you see OPEC cuts 4.2 million barrels from the daily supply, supporting price. Back in November of 2014, Saudi Arabia decided to no longer be the swing producer and to expand or contract crude oil production in order to maintain a stable market price. So with that, you saw the tremendous crude oil drop from $100 a barrel down to $26 a barrel just this last February. So they tried to well, their thought was they could push it back on us now that we're the largest producer of petroleum in the world, that we might become the swing producer, or they might damage our industry somehow by letting the price fall so precipitously. Now, again, the market's beginning to rebalance. There's only about 500,000 to 1 million barrels a day of imbalance within the markets, the global markets. We feel like that most of the producing countries in the world are at or near capacity, so there's not a lot of ability. A lot of it's guesswork. A lot of the experts say that Saudi Arabia only has 1 million to 1.5 million a day of excess capacity that they could bring to the market. Iran is trying to ramp up, but they're only about 200,000 barrels a day from being at their maximum production capabilities, at least with their infrastructure as it is today. So, Taylor?
I think that's me.
There you go.
Thank you. All right. So, as Reed was saying, unless you've been under a rock, you've probably heard a lot of news about OPEC over the past couple of years. So we're going to talk a little bit about OPEC and a market update in general. And then we're going to talk about a few terms that you hear in the news that are affected by prices and that might affect prices as well. Things like rig count and storage for both crude oil and natural gas. So I think we all know who OPEC is. I was interested to see the full list of the countries, and notable absences are obviously Russia and China as number 3 and number 4 producers. And lately that's been interesting in the news because on Monday, Russia and Saudi Arabia met and had made an oil cooperation agreement, which doesn't necessarily mean much because it wasn't an agreement to freeze production just yet, but I guess to work on it. Sentiment is kind of up and down on that. We've heard from a research firm, Wood Mackenzie, earlier in the week that they think there actually will be a production freeze because a lot of the countries are close to their maximum production levels, and we'll get a little more into the details of that. It remains to be seen. If you look at the Wall Street Journal today, there's an article saying, sentiment doesn't have confidence in a production freeze coming up. So you'll also notice some of these countries, Venezuela and Nigeria are, for example, and some of the other countries are really affected economically and experiencing some civil unrest due to the low prices. So it might be great for you and me to have low gasoline prices to put in our cars, but both at home where we're seeing bankruptcies, and we'll get into some of those details as well, that affect especially Texas and Oklahoma, and abroad where some of these countries are experiencing unrest. It causes the economies both globally and locally to suffer a little bit. So what happened in November of 2014? So we had seen demand in both China and India start to slow in 2014. And Saudi Arabia, as Reed mentioned, looked at it and said, we don't want OPEC to be the swing producer anymore. We don't want to take this pain when the U.S. is the top producer now of crude oil. We want to share in that pain and cause an adjustment there. So WTI, our primary West Texas Intermediate, our primary measurement. You'll also hear Brent crude quoted as well, but we focus on WTI as the primary measurement. Fell below $70 immediately, and then we bottomed out at 26. Hopefully that's the bottom, we'll see, in February of this year. So interestingly, when we kind of circle back to the production freeze, OPEC is meeting in Algiers later in this month. It's September 26th, so if you want to keep an eye out for the news in an informal meeting. But as that firm, Wood Mackenzie, told us, the production freeze may be likely. And to us, again, not EastWest Bank's opinion, but my personal opinion, a production freeze may be likely. The Saudis are producing at 10.2 million barrels, and they've said they can produce at 12.5 million barrels. But that's, if you look at trends over the years, they've never gone above the 10.2 million barrels. So you kind of wonder if that's likely. We don't have a lot of visibility into their actual production. And you would also ask yourself why, if they're trying to kind of shift the pressure to the US to be the swing producer, why would they not be producing at that full amount? Another interesting metric to note is that over the past decade, they've tripled their drilling rigs in Saudi Arabia. So why aren't they producing at a higher level? And some of the data says that their fields are older, so they have to triple the rigs to get that production out. Another interesting metric to note for Iran, as Reed said, they're at 3.8 million barrels a day of production. So they only have an additional 200,000 to go to meet their capacity of 4 million barrels. So that's not a huge jump. So like I said, the production freeze could be likely because they don't have a lot to lose. We also don't think if that happens that it's going to prop up prices much beyond where they are, maybe a few days for sentiment. So another interesting thing, just to kind of recall, I'm sure you've all seen that Aramco has mentioned that they're going to take part of the company public, and that would be a estimated $2 trillion IPO. So that would be huge, and it also would provide some data on Aramco that we don't currently have access to. So flipping over to, let's talk about domestic bankruptcies. This data is from Haynes & Boone. So if you go Google Haynes & Boone Bankruptcy Monitor, there's a lot of interesting data out there, and they update it monthly for new bankruptcies that happen. So that's interesting data to have and check out. This is just exploration and production upstream companies. So 90 of these bankruptcies have happened since the beginning of 2015, and for oilfield services, it's been 83 bankruptcies. Interestingly, also Deloitte says about a third of the oil and gas companies have a risk of being insolvent. So if you're looking at bankruptcies that have happened lately, we've had some interesting paradigm shifts from cycles of the past. For example, a lot of these companies are going to court with already restructuring agreements in place. So that's made the process a little more efficient. Also, most bankruptcies now have been filed in Texas instead of New York and Delaware. I think the thought is that Texas judges are more familiar with energy and the process can be a little more efficient. So interesting fact to note there. So Reed I won't steal his thunder for later, but as far as how we lend, it's been a shift there as well. So for example, a lot of our customers, well, luckily we have good loans right now, but a lot of my former customers, if they're about to file, they'll draw down their whole revolving credit facility to be in a good negotiation position for themselves going into that bankruptcy. Well, we begin to add covenants to their credit agreements to prevent this. So they're pretty complicated because the company needs liquidity in order to operate, but there are limitations on how much cash they can just draw to hold on their balance sheet to prevent that kind of action. Additionally, we've required increased collateral, and obviously loans have gotten a little more expensive, but that's already ticking down because sentiment's a little better about the stability of the market. And as you may have heard as well, the regulators have been kind of breathing down our neck. So they've tightened regulations on how you look at debt. So we used to be able to bring in junior debt tranches and not have to look at that as punitively. So we could kind of say, well, they're after us in the debt stack, and no longer is that the case when we look at rating credits. So that's been a real struggle for banks right now. So let's tie that into some terms in the news. So obviously OPEC, affects prices. The strength or weakness of the dollar affects prices. Actually today the dollar's a little weak, so that's keeping prices somewhat stable at about $44. But let's talk about some other things like rig count and storage. And it's interesting because they both affect prices and affect sentiment and are affected by prices. So as far as rig count, this is a chart of rig count by basin, obviously in the US. Baker Hughes releases this data, so if you go to their homepage, you can see an update on the data. It's viewed as a proxy for sector activity, so it can definitely affect sentiment. And as of the 2nd, there were 407 crude rigs drilling. And if you want to compare that to 2014, in October 2014, we had 1,609 rigs drilling. So that's an interesting data metric. We have 88 natural gas rigs and just 10 offshore rigs, which is kind of expected because offshore drilling is a lot more risky and a lot more expensive. In fact, a lot of banks kind of steer away, traditional lenders like us steer away from offshore drilling because it's so risky. Your company really has to know what they're doing with that capital. Predictably, most of the rigs, you'll see the Permian, I believe it's that second bar right there. A lot of the rigs are operating in the Permian, so 207 of that 407 are operating in the Permian. That's one of the most economic areas right now at this price level. So if you see M&A activity in the news, a lot of it is in the Permian or actually the Scoop Stack play in Oklahoma. I don't believe that's separately represented on this chart. But look for those two plays to be kind of the hot areas right now. But I'll let you be the judge if it's overblown in some of the purchase prices. So let's take a look at storage of crude oil. That's something else that reports frequently come out on. The EIA is the U.S. Energy Information Administration. If you go to their website, there's a lot of data on prices. It's very data heavy, but it's useful and very reliable data as well. So storage capacity for crude oil has actually increased recently. That's reported twice a year itself. And we're thankful for that because we've reached a high of 73% usage of our storage capacity given the downturn right now and the supply outweighing demand. So that's primarily in Cushing, Oklahoma, and on the Gulf Coast is where our primary storage is. Internationally, some countries like Russia and China choose not to report their storage data. So that's interesting. Additionally, some of the smaller countries, some of the other countries in OPEC, they do report their data, but it's not necessarily reliable. For example, Singapore, they don't report their data and they have one of the largest storage fields, so we don't know how much oil is sitting in their tankers, and it's actually been measured by the water depth. People try to guess what that is. Scientists will try to guess what that is, but that's oil that could flood the market as soon as prices rebound, so you don't know what's going to happen there. So it's an interesting kind of unknown. One thing, as I was kind of doing my research, we have 695 million barrels in the U.S. Strategic Oil Storage Reserve. And I was surprised to find out that would only last us about 36 days. So maybe kind of a scary metric if we go to war or something. I hope not. Natural gas storage, on the other hand, is very cyclical, especially due to its tie-in with heating season. So April through October is injection season into storage. Obviously, you can see the metrics up here. The most interesting thing about natural gas storage is you kind of ask how do they store it since it's a gas. So it'll be, the main way they store it is depleted oil and gas fields because there will be a cap on there, a natural cap to hold the gas in. The other ways are depleted aquifers that have impermeable cap rock. And lastly, salt cavern formations, which that's primarily on the Gulf Coast. And that kind of ties into liquefied natural gas because that's easier to store when it's cold to extreme temperatures. So it's converted to a liquid form, which it's actually a vapor form. It's a more feasible way to transfer gas long distances since we've historically been bound by pipelines. And that's why so much of our gas is domestically delivered and used here. The US, I think Reed mentioned this, we are heavily switching from importing LNG to exporting LNG. And this actually takes a lot of time because of the expense of of building the LNG terminal. So for example, Cheniere is building a Corpus Christi LNG terminal, and the estimated cost is 10 to 12 billion. And that's a many-year project, so it's a huge investment. So these 12 terminals I mentioned are actually import terminals, and there are 10 terminals that have been approved by the regulatory body called FERC that are being constructed right now, but that's a heavy project. So it's not more widespread yet as far as exports because it takes so much time to build those terminals and so much capital investment. Something else to note though, in looking up some notes from a research firm, is that with the construction that's in place, we're actually kind of maxed out on LNG. That's not going to be globally at least, that's not going to be a huge solution to propping up natural gas prices. And that balance where demand will outweigh supply probably won't happen until 2023, 2024. So don't look for a huge spike in natural gas prices, at least in my personal opinion. Okay, and the last controversial topic, fracking. I don't know if any of you felt the earthquake on Saturday. I didn't myself, but it's kind of relevant for today. So this is kind of a picture of a horizontal well and a representation of fracking. And I'm sure many of you know that they flush at high pressure water and proppant that's in that water that's usually sand, but sometimes ceramics. And many companies are kind of tinker with their own special recipe for that particular rock for what's best. So they do it in stages. So only one stage in that horizontal part of the well will be fracked under high pressure, break up the rock, and then they'll move on to the next stage. It's been around for 60 years, but as you probably know, it became more economically viable in the 2008 timeframe and really widely applied to all of the shale plays. So there are obviously several concerns related to fracking. One of them is the earthquake concern. And part of that has to do with the saltwater disposal wells that get the flowback fluid from fracking and fluid that comes out of the well in general as a byproduct are flushed in these saltwater disposal wells. And it's thought that that can help generate earthquake activity, especially in Oklahoma. And there are opinions on both sides. I don't have a definitive opinion on whether, what's going on there. You see the Oklahoma Geological Survey who's very concerned about it, and then people on our industry side who are not. So you kind of be the judge of that. Regardless, it will be a big economic cost to Oklahoma. So that's just something to think about. The industry is so prevalent there, so it'll be a cost to research that and to manage the risk there. A couple of other risks, especially related to water, people worry about aquifer pollution. You'll interestingly note that most aquifers are about 500 feet below the surface, and this well is drilled 6,000 to 10,000 feet below the surface and encased in several layers of pipe. So, in general, we should be safe there. It's highly regulated. So you can be the judge. Everyone has their opinion, but if you go out to a well site, there are a lot of, in addition, the water coming out of the well, there are a lot of regulations to make sure that's protecting the land. So big issue in our industry, and big issue for us to make sure our customers are doing the right things environmentally, because we don't want that liability. So now I'm going to pass it off to Reed to talk a little bit more about how we lend in our space and what we do here at the bank.
Thank you, Haley. Okay, a little oil and gas. Oop. Yeah, this is Oil and Gas Lending 101. I'll start with this slide. Basically gives you the life cycle of a typical, what we call upstream exploration and production company. It's very capital intensive, and on the front end, they're acquiring leasehold, which has no associated cash flow, so that requires family capital, private equity, business angels. I've seen situations in the last few years where $200–300 million has been spent with private equity money just to acquire leasehold in order to do future development. And in some of those cases, as I mentioned earlier, the natural gas distribution system in the United States is a fairly mature business, but as it relates to Marcellus and Pennsylvania in particular, a lot of this acreage was acquired with no infrastructure. So that 200, 300 million that was spent all of a sudden got caught up in the downward price cycle with natural gas going from $4.50, $5 per thousand cubic feet down, below $2 per MCF as we refer to it. So at that level, it's not viable to both drill the well and build out the infrastructure to produce the gas, particularly when the gas price was a result of an excess supply. But in a normal cycle, we generally, as a commercial bank, we generally get involved about midway through the takeoff phase. The venture capital phase is where there is we're always lending into cash flow. People ask us, 75% of our credit underwriting is centered around cash flows and future cash flows. The other 25% can be this development cycle as the company continues to spend capital. I've seen a lot of situations, if you go back more than 2 years ago, a lot of these companies that were private equity funded with some commercial bank debt, a lot of them sold out. A lot of them did their exit, their asset sale before they even got to the development phase. With the shale revolution and the appetite for bigger and bigger companies, particularly public companies, in order to feed the street, as we call it, tell the investor public that, hey, we're building, we're growing. A lot of these companies actually got sold out way before the development phase. That's different from 20 years ago when this business was a buy and hold business, particularly with the families and the private sector and even the public companies. If you go back 20 years, it was a buy and hold strategy. They would develop the asset and actually just maintain the production for a long period of time. That all changed about 6 years ago into a buy and flip strategy. So again, a little reserve-based lending 101. What EastWest does and what most commercial banks do is we lend to E&P, or exploration and production companies, what we refer to as the upstream part of the business, and midstream companies, which is the infrastructure to move natural gas and crude oil from where it's produced to where it's consumed. The midstream segment of the business is also heavily related to the reserves in the ground. We have to evaluate, okay, are there enough reserves in the ground that are going to be produced by the upstream businesses to feed the system and make it an economic project for the midstream segment of the business. The one that's not mentioned here is what we call downstream, which is the refining and processing segment of the business, which is historically been a very risky endeavor for commercial banks. So we're not going to be lending to many refineries. So the next thing we look at is the management quality, what their track record is. Private equity firms do a lot of vetting for their management teams. We don't rely on them completely, but they do their homework in terms of sizing up management and staking them with hundreds of millions of dollars typically. And then on the technical team is both geological, understanding the areas that these companies are investing in, the geology and the engineering, and then the operational, the actual execution of drilling the wells and getting the resource to be produced. Again, I didn't mention earlier, before the talk, I was talking about capital sponsorship. What has changed in our business is upstream companies and midstream companies had a tendency, when money was available from commercial banks and from other mezzanine type lenders, anytime you have a price shock, as we've seen, they become over levered relative to how much debt burden they have, relative to how much cash flow they can produce. So to correct that, both for existing situations and for go-forward situations. The capital sponsorship, the private equity component is going to become increasingly, or has become increasingly more important to our business of lending from a commercial bank's perspective. Then the quality of the properties is always important. We look at assets in terms of both the cost of producing the properties and also the concentration of the production, because we don't want to be too heavily concentrated in a few number of wells or a single lease, because there are some operational concerns, mechanical concerns. We've seen wells that have stopped producing because the wellbore has collapsed, or if you're too heavily dependent on one well or one lease, and the geologists and the reserve engineers are wrong that there aren't that many molecules in the ground that are going to be produced, and you have to revise that estimate downward, it becomes a real problem when you're doing your valuations and doing your estimation of what future cash flows are going to look like.
So you don't depend on Netherlands Sewell reserve report. You pinpoint a specific field or a specific well, and you said, I don't agree with the engineers.
Well, we start with the Netherlands Sewell report. Netherlands Sewell is a well-known international third-party engineering firm, and they do excellent work. And you also have Ryder Scott and Cawley Gillespie. So you have some nameplate companies that are third-party reserve engineers that we rely on heavily.
Right.
We employ our own reserve engineers. We have 2 on our staff that their job is to go through the third-party reserve report. There's general consensus between our technical staff and the technical staff that's either hired by or contracted by our clients. It's just, there are so many variables.
It's not a slam dunk.
It's not. There's a lot of art as well as science to determining. I mean, they look down the wellbore and they say, okay, we're going to produce 10 BCF of gas, billion cubic feet.
Right.
And that could be wrong plus or minus 30%. And so if we're wrong by 30%, then our valuations, as we look at our loans every 6 months, we do an asset review every 6 months, and we do exactly that. We reevaluate what reserves are going to be produced. We have to say, okay, at what price are they going to be, or what cost are they going to be produced at? What price are they going to sell the commodity for? And we come up with a cash flow analysis that goes out 20 or more years. And then we talked about the reserve report. We have to determine, as I said, what price this commodity is going to be sold for 5 years from now. Well, the way EastWest Bank does it is we look at the financial markets as being the most transparent and the most collective conscious of everybody who's interested in the crude oil or natural gas as a commodity. We look at the price strip, the NYMEX price strip. And we look out 4 or 5 years and we say, okay, this is what the consensus is of the market of what this commodity value is going to be. And as a lender, we have to be more conservative than that. We're not trying to predict what prices are going to be. We just have to pick a price that is safe enough for us to lend money. And that number today is 85% of the forward market is what we are going to use for lending purposes. So we apply that to the reserves we think are going to be produced, at what cost they're going to be produced, and we come up with a discounted cash flow analysis. Now, there are different types of reserves. We're cash flow lenders, so PDP is proved, developed, producing. That's what's producing today. That's our 75% of our reliance is going to be on PDP. PDNP is proved, developed, non-producing. Science tells us the reserves are there. They're going to be produced at some point in the future with a little capital investment. They can be produced in the future and will generate a cash flow as a result. PUDs are proved undeveloped reserves. That's a well that hasn't been drilled yet, but you have a well next to it. And so you can correlate, the geologists and the engineers can correlate that this proved undeveloped well is going to produce, after you drill the well and make the capital investment, it's going to produce at a rate, at a price. The advance rate, as I said, we use a discounted cash flow analysis approach. We use a PV9, 9% discount. The advance rate is typically about 60 to 65% of what the present value, net present value is today at 9%. We look at the reserves twice a year. We adjust for reserve estimates. We adjust for cost trends. We adjust for price. And then we do it all over again. We do our discounted cash flow analysis again. We apply our advance rates. We make sure that the future cash flows will amortize the debt in an orderly fashion. And so it's not a jump ball, but every 6 months we're resetting what amount the borrower can advance under a revolving based loan. And then hedging, financial covenants. Didn't mean to skip over that. That's very important because in March of this year, the Office of the Comptroller of the Currency kind of changed our world, and the Fed and the FDIC followed suit. The biggest change was they determined that all debt is created equal. We used to play in an arena where we were the senior secured lender. We had payment preference, both in cash flow and liquidation. We almost always got paid. And so if we had second lien debt or mezzanine debt or unsecured bonds behind us, we were more or less interested that our customer was able to service the interest and keep current and not default on those obligations. But in terms of impacting our ability to be paid first, we gave it the position we thought it was in was secondary. Well, now the government has come in and said all debt's created equal, which means when you're testing leverage, when you're testing total funded debt against last quarter's EBITDA, last quarter's cash flow, all of a sudden leverage profiles jumped, sometimes from 3 times to 6 times. You know, our comfort in terms of covenants as a senior lender, we like to see leverage maintained, and the government agrees, at 3.5 times or less. You see a lot of existing situations that are over 4 times levered. My business is all new business, new management teams, new opportunities, because a lot of existing companies are they're kind of stuck where they're at because their leverage profile is 4 and 5 times. And if I were to refinance it, the government would say, well, you just booked a substandard loan, and my management in Pasadena wouldn't be very happy with that. So, on the price side, we're very bullish on hedging. Many companies went into 2016 unhedged because they were unhappy with the forward price. Well, many of them would be more than happy to have $65 or $70 crude oil prices today had they hedged back in late 2014 or early 2015. So we're really big on hedging 2 years out and kind of making it a rolling program, which every fiscal quarter. Minimum 50%, maximum 75 to 80%. We feel like hedging over 85% is kind of getting into a speculative range because of the variability of future production. Right. We've seen some situations where they were hedged at 80, 90%, then you had your reserve revisions, and all of a sudden they're 110% hedged, which is okay in an upwardly moving price market, but not so much.
You don't look at 2Ps and 3Ps at all? We
don't look at 2P or 3P. What Max is referring to is what became prevalent with these shale plays in particular was probable and possible reserves. What I talked about under the reserve categories under risking, those are all developed. Geologists, engineers, third parties, banks all agreed that the reserves were there in certain quantities and can be commercially produced at today's price. Probables and possibles are reserves that are extensions of fields where there is no existing production, there's no control, as we call it, there's no closology, you don't have a well across the fence line that you can correlate to drilling a well in this location. So you have, And many times we've been asked, do we give value for acreage that has 2P, 3P, which is probable and possible reserves? And the answer is no. Wall Street may like it, but the commercial banks don't. So again, I touched on it. We have 2 reservoir engineers on our staff. What they do, they have the capacity, the capability of producing an engineering study from the ground up. That's not their function in our world. Their function is a review function, looking at the third-party reserve reports that our clients present to us. Mortgages, all of our lending is secured. We like to take at least 90% of the value of the oil and gas properties under mortgage. Sometimes that last 10% you get into diminishing returns. It's just you get into the smaller values, and the cost is just not practical to go for that last 10%. Collateral meets loan requirements. We have guidelines around concentration of value. As I touched on, we can't lend on one well. We like to have an oil-gas mix. A lot of companies are weighted almost 90% one direction or the other, but it's always best to have a balance in your reserve mix. The third-party reserve report, and then many of our companies are startups. They're funded by private equity, so there's not a lot of historical financial data, but they're usually buying the asset from somebody who has operated the property for a period of time. So we can look at the historical production. The decline curves are what the engineers say the future production is going to look like, and then the lease operating statements are what is the cost associated with this activity. And that's important because that's where, as a lender, we can make our biggest error is not getting the expenses right, because that can really impact your cash flows and your discounted cash flow analysis. And back on that, again, in the news this week, the earthquake in Pawnee, Oklahoma, that the USGS and other experts are blaming on saltwater disposal. This was an unusual situation in that the article I've read said that the earthquake originated epicenter was only about 3,000 to 4,000 feet deep. Now, most earthquakes happen much deeper than that. So that does correlate where saltwater disposal operations are occurring at that depth. So it's curious, I'm not a geologist, but it's curious that they had such a shallow earthquake, and so immediately the state of Oklahoma, the regulatory bodies, they shut in 37 saltwater disposal wells. The problem with that is, as it speaks to cost, on the lease operating statement, it costs 25 cents a barrel to dispose of salt water in a saltwater disposal well. It costs about $1.75 or $2 a barrel to truck it. So if your option to dispose of it in a historical fashion at 25 cents a barrel, if all of a sudden your cost is now $1.75, it significantly changes the net profit of the project and the resulting discounted cash flow. So we're paying particular attention to that. But in Oklahoma, with oil and gas operations, you'd produce, absent hydraulic fracturing, there is a lot of water produced along with the crude oil. In many cases, the water production exceeds the barrels. You have more barrels of water production than you actually have barrels of crude oil. So it's a real it's a real costly situation if you're no longer able to inject that in the ground and have to truck it to some other site. Where are oil prices going? You have people on all sides. Again, my personal opinion is we're kind of range bound between 40 and 50 for 6 months to a year. It ought to break out above 50. Again, we're achieving balance in the market, but it's going to take a little more duration, a little more working off that to get above $50 a barrel. probably to this $60. You know, I'm more in line with the chairman of Anadarko than I am with the $10 barrel. I mean, I've seen $10 barrels in my career twice. I don't really want to see it again. And Harold Hamm is always pretty optimistic on crude oil. He has to be.
Yeah.
Here's if you want to go look for some of the information we've discussed today. The EIA and the rig count, the Baker Hughes, the Wall Street Journal always has good articles on energy. And then the Bankruptcy Monitor by Haynes & Boone.
Thank you so much. We're a little out of time, so.
I'm sorry.
That's okay. So you'll stay for afterwards for questions, and people that have to leave can leave, if that's okay. So next time, October the 5th, we'll be talking about conflicts in the workplace and how you become a better leader, working through those. So again, they'll stay and answer questions for anyone, and if you have to leave, then feel free to. We have parking that'll be validated, and pick up your CPE. If you must leave, go ahead, and then we're open for questions, okay? Anybody has any questions? Does anybody have any questions? Okay, good.
What's your projection on oil prices, say, 2 to 5 years now? About 1 year.
Haley, you want to take that?
I read this morning in 2017, the thought is maybe we get up to 60, 55 to 60. Beyond that, I have to get out my crystal ball.
No, I think absent some geopolitical activity, I've always thought 60 to 70 is kind of the market clearing price for crude oil. You know, you could see it lower as it is today. You could see it. Will we see $140 a barrel again? Probably not. So, you know, in the 60 to 70 range, 3 years out.
Ms. Linders, are you worried that the earthquake issue could become a liability for some of the companies that you're lending to? Are you factoring that into the loans?
It's definitely something we look at. We have some loans in Oklahoma and that are high water producers, so it's something we had already discussed when making that loan. So it's something we closely monitor and call our borrowers when an incident like this happens. But we risk heavily the reserves, so that gives us a little bit of leeway, and especially that we look at the loans every 6 months. So that's helpful.
Yeah, from a cost perspective, yes, but I think maybe you mean from a litigation perspective. We really haven't addressed that yet. Now, we've had operators that have had saltwater breakouts, saltwater spills on the surface when the EPA gets involved. That's a little. We do factor that in. But in terms of legal liability for causing an earthquake, we haven't factored that in yet.
That wasn't part of the elements of de-risking the contract or the evaluation of drilling a well. I mean, that's fairly new. That was not an element that was considered in the lending before, or was it?
The risking of
Earthquakes.
No.
I mean, that's almost force majeure. You know, it's not really something that's part of your ongoing business.
right.
And I'm certain it is not related to the fracture.
Well, and you have to
That's
ask
my-
how you prove causality
Right.
from one certain producer that their specific disposal well
Right.
caused that.
Yes.
Just a comment, your presentation materials were outstanding. You know, for the first time, I've been able to understand the different processes.
Oh,
Thank
Very
Thank
easy
you.
to follow. Very good.
thank you.
Thanks.